Intervention. It is the story in financial markets this morning. Just yesterday, the G7 agreed to weaken the Japanese yen after the currency surged to a post-war high, threatening the economic recovery that country so badly needs in the aftermath of its devastating earthquake and nuclear disaster. But will the so-called yen-intervention work? We're about to find out. Alessio de Longis is here. He manages the Oppenheimer Currency Opportunities Fund, and he's part of a team of portfolio managers who run almost $20 billion. Alessio, welcome back. It is working. If we look at the charts, you can see a dramatic move in the yen weakening after the G7 started to take steps. But is it going to hold? That's the question that everybody wants answered right now.
Well, that's really the question, right? If you remember back in September, we had a unilateral intervention by the part of Japan, but it didn't work for more than 2 days. This time is slightly different because it's a coordinated intervention. And what's important to know is that coordinated interventions have the potential to work much more. They can work.
But what determines success?
In my opinion, there are two key ingredients. One is the fact that they are coordinated and not unilateral, so we're halfway there. But we need divergent cyclical policies. We need, in particular, divergent monetary policies between the two countries of the currency pair involved.
I kind of understand what you're talking about, but we need to explain it for the audience. When you say divergent, on the one hand, you have Japan, which is doing everything it possibly can to weaken the yen and keep monetary conditions loose, easy money, etc. The Fed is trying to do the same thing. So who out there can actually work against the forces of Japanese easing?
Precisely. The Fed is not likely to embark upon a meaningful tightening cycle anytime soon. So is Japan. So with respect to the G7 countries, the only one that seems to have a potential for meaningful divergence is the ECB. So we may expect more success on the euro-yen cross rather than the dollar-yen.
Oh, that's a very interesting point. So we may actually see more movement between the Japanese yen and the euro than we'll see between the Japanese yen and the dollar, which is what we're flagging right here behind us.
Because of the cyclical divergence, exactly.
Okay, so what ultimately is that going to mean? Is that going to mean that the Fed ends up spending less money and the Fed will actually sell fewer yen than we might see the ECB or its constituent banks like the Bank of France and the Bundesbank already out today saying that they did in fact participate in intervention?
That is not clear. It may actually turn out to be that the Fed will need to do more to achieve the same result. And also it will depend on how market participants will interpret the future developments. In particular, let's see how the repatriation versus speculation balance on the yen flows will actually play out.
Well, here's a key question. What were we seeing 2 days ago when the yen surged to 76.25? Was that speculation or was that repatriation?
I think it was more, we can call it speculation or we can call it short covering on the part of global fixed income investors who tend to run globally a structural underweight in the Japanese fixed income market because of its low yield.
So they were trying to get out in front of what they thought was going to happen.
Or at least cover the short positions. They may not have engaged in speculative active long positions, but definitely the evidence that this was short covering more than actual repatriation by Japanese investors is compelling.
Well, any time, though, that we bring up intervention, what comes to mind for so many people is George Soros and the Bank of England. What happens if speculators, and there are many, decide to wage war with the G7? Who wins?
The G7.
Ultimately, you think they're prepared to put that much money to work on Japan's behalf that anybody who tries to fight the tide is going to get burned?
I think so. We have learned that we have lived extraordinary times over the last 2-3 years, and we have seen that policymakers have the potential to achieve what they want to achieve.
Do you think they're going to try? I mean, it's a crazy conversation because on the one hand, right, the speculation in this case seems quite heartless. Right? Japan is flat on its back. It has had a devastating earthquake. It's in the midst of a nuclear disaster. What Japan needs from everybody is help. And if you see people buying yen in an effort to strengthen it, it doesn't really feel, maybe it's not their job as fiduciaries to help Japan. But by the same token, there are market forces at work, and again, the fiduciary has to fulfill his obligation to investors.
Yeah, let's also not overestimate what is the purpose of policymakers. We are not trying to weaken the yen to levels that are extraordinarily different from the levels we're seeing today. Their primary aim is always to stabilize volatility to establish a fairly reliable range, trending range for a certain currency pair and mitigate that volatility. If you think about the pre-earthquake levels, that would translate into a euro yen around 114.50 and a dollar yen around 83.50. So the numbers are not that different from the numbers we're seeing today.
Okay, very quick question before we go, Alessio. If you don't want to get out in front of that speeding freight train, what currency would you be buying right now?
An alternative to the yen story would be the Swiss franc, because it shares some of the same characteristics in terms of being a current account surplus and large net creditor to the world nation. And because it's not in the center of the spotlight, it will enjoy a little bit less volatility and will make it a more attractive investment vehicle if you want a yen proxy to your investment story.
All right. Alessio, thanks so much for joining us. Alessio de Longis of Oppenheimer Funds saying that, yes, coordinated intervention will work, but if you don't want to get caught in the middle of that yen trade, try the Swiss franc.